Hello there and welcome back to my YouTube channel. James here as ever for another important ACCA video, especially if you've got your upcoming performance management, that's the F5 paper. I'm assuming that is why you've clicked on this video, because I'm going to be going through for you a whole Section A review of the most up-to-date computer-based examination that you can access on ACCA's website. What I've done for you is I've put the link to actually access all of the questions, that's 15 in total, in the description below. If you click that, it's going to take you straight to it. If this is the first time you've visited my channel or clicked on one of my videos, my name is James. I'm an ACCA qualified member from the UK, and my channel is set up to help ACCA members around the world, wherever you may be located, with my skills, my knowledge, my experience, The channel is all set up to help people like yourself, because the main important thing is every video is dedicated to one of my subscribers, and today is no exception. So, Struthy, I know you're out there and I'm sure you'll be looking forward to this video, but Struthy left me a lovely comment at the bottom saying, amazing video, can you make a video like this 4 PM, that's the F5 paper, for the December 2030 exam? Well, I'm sure I don't want to do it that far into the future, as I'm recording this in 2021, but I've done you through the most up-to-date examination I can get my hands on. Really need the motivation to pass PM, thank you. Well, Struthy, if you follow these tips that I'm going to go through in this video, watch all the way to the end and check out on my channel the other F5 and PM videos, you are going to be absolutely sorted. These are the tips, these are the sort of things that I'd be thinking about if I was in your shoes. What I've also done for you is, in the description below, I've put all the recommended texts and resources that I'd be looking to actually purchase to pass this examination. So check them out, there's a few discounts down there, the ball is in your court. Well, without any further ado, make sure you've clicked on the link, as I said, in the description below. But before we get started as well, make sure you give this video a massive like so that more ACCA students can see this video, so that YouTube knows you actually enjoyed it. Also, if you've got any requests of videos you'd like me to do, leave me a comment at the bottom down there. Plus, whilst you're down there as well, if you'd like access to all of my free videos, feel free to subscribe and you get all of my updates on a timely basis. I mean, what more could you want? So, get comfy, make sure you're going to watch all the way to the end. I'll leave little gaps throughout the video so you can actually answer the questions as we go through. I'd highly recommend you give it a go first of all, then get your pen and paper at the ready, watch the video all the way through as I said, and you're going to get so much out of this. So let's head on to the main screen, just like if I was in your position. 3, 2, 1. Okay then, so if you've clicked the actual link in the description of this video, this will appear on your computer screen directly on ACCA's website, looking at the performance management, that's the full specimen exam, as you can see at the bottom of here. And this is what we're going to go through in this video, going through Section A. So all you need to do is just click on that link there and go through all the sort of procedures up at the start, and it's going to take you through to this exam summary. Now this video, as I said, we're going to go through Section A, the 15 objective test questions. I'm going to walk and talk you through the question and answer analysis. What I will also do is for you is I will slow down, I will actually pause, and you can pause this video, attempt it yourself, and then we will actually walk and talk through the answers to help you out if I was in your situation. As you can see on there, we've got section B and C, so if you would like me to do the video on that, feel free to leave it in the comments and let me know what you think of this video as well. Now, the final thing is, the really key element to passing this exam is doing it to time. So this is 30 marks on here in total. The video is probably going to be a bit longer than this, but it's a case of you would have 54 minutes to complete this. I'd recommend that you try and get it done in 45, so that you leave yourself 9 minutes to actually go through and review it. So, pen and paper at the ready. Let's walk and talk it through, shall I say, together. And I'll say to you little tips, little hints, so make sure you get it all jotted down, that is going to help you pass your upcoming actual PM exam. So without any further ado, let's get started on here. Looking forward to it now. Are you ready to begin the exam? Of course we are. We are in the right place. There you go, a little breakdown for you as if it was the actual CBE setup. And here we go. This is question 1 on here. So, how would I walk and talk the questions through 1 to 15? Let's get stuck into it. Stay with me, watch all the way to the end. So, as you can see on here, Go straight down to the actual requirements. So using activity-based costing. Now, if you're a PM student, question 1, you see ABC on here, you go, all right, okay, whew, we're going to be fine. Don't you worry about it. Using activity-based costing, what is the budgeted overhead cost per unit of product D? Okay, so I can see product D here in the column. The total is going to be really key. I'm not really sure what product C is there for, apart from the total on here. So let's just go through the details we're given. A company manufactures 2 products, C and D, for which the following information is available. Okay, so we've got 2 tables on here, which we'll come on to. Other overhead costs are absorbed on a labour hour basis. Okay, right, other overhead costs. So I can see other overhead costs here, 96,000, and that is on a labour hour basis. So labour hours per unit in total. Okay, so we've got 10 for product D on there, 8 for product C, and 48,000 in total. Now, a really good way of picking up on these things from an exam technique perspective. Now, look at the figures on there before you start to actually answer this and go, hang on, 96,000, 48,000. Those numbers are nicely aligned a bit, aren't they? So I'll leave that with you on there. Now, another tip, if you get any activity-based costing kind of question, is when you're actually being shown the total cost, so on here you've got production and inspection and overheads, you've got to align those up to the other bits of narrative above. So in other words, what I'm looking for here is total production setup costs, and then I go to myself, okay, well, where's this linking in? Well, we've got production up here, okay, and we've got 15 for D and 28 overall. Then we've got inspection costs on here, so I'm linking inspection to inspection, so 3 for product D, 8 in total. And then the actual other overhead costs, which we know are absorbed on a labour hour basis. So there are labour hours, 10 for product D, 48,000 in total. And the key thing, just so that we're crystal clear, because people will make mistakes taking the total amounts or including product C on this, we've only got 4,000 for product D. Okay, so if you want to have a go at this question, pause the video now. I'm going to run you through the answers and the key elements for this, but you've got a little flavour for it. So let's have a look at the answer as we go through. Let me move it over here. As ever, I'm down here. All the important information going through the exam is up there for you. But just as we sort of walked and talked it through, and we're going to align up the figures on here with that narrative as we talked about. So let's keep it simple. The production run, as we said, so we're just walking through these total figures all together. The 140,000 for the total production setup costs. Well, we said, okay, well, where does that align to production that we've seen above? Number of production runs here. So we had 15 for product D, but the key elements as we're breaking down the total figures is we've got to be looking at the total amounts for C and D combined. So 140,000, as you can see, divided by 28 gave us 5,000 each. And then we just walk and talk it through. It's the inspection costs on here are 80,000 in total. Break that down between product C and D again, which you've got the 8 on here corresponds to the 8 on here. Notice again, inspection, inspection. And then finally, as we actually indicated to us, the overhead costs are absorbed on a labour hour basis. So there's our other overhead costs, the 96,000. And this is where the 48,000 came in. So you don't make those mistakes. You think, hang on, 2 48s make 96. And hence that gives us our actual overhead cost per labour hour to be $2. Okay. So then we're actually thinking to ourselves, okay, we've broken down the total into sort of separating it out between C and D. Now we need to focus those overhead costs directly to product D. So head straight over to the actual column there for product D, take the figures that you've worked out before, and then start to apply them. So keep it simple, follow the same process. So we started with production runs. So you've got the 5,000 there multiplied by the 15, again directly related to D. Then you've got the inspection cost there of 3. So again, what we've got on there for D, there's the 3. And 10,000 overall cost per inspection. Now, this is where people will make a mistake. So get it jotted down on here. For the other overheads, yes, we've got the labour hours per unit, which we know are $2 on here. Okay, so what you need to be doing here is saying to yourself, well, there's our $2, but we've got 10 hours, okay, to make each unit, and we've got 4,000 units in total. So the 40,000 there comes from the 4,000 multiplied by the 10 to give us our 40,000, and then multiplied by the 2 up there. So that gives us our 80,000 in total. So the total overhead costs, I know there's no narrative on here, but if you want to get it jotted down, the total overhead cost for product D overall for the full 4,000 units is $185,000. And then the final bit on here in your actual calculations is saying, okay, well, I've worked out the total to be 185,000. How many units do we have in that? And again, refer back to your column. Another mistake here is people will divide it by the 5,000, not the 4,000. Remember, we're being asked specifically for product D. Divide it by the 4,000, and that gives us our answer of $46.25. Oh, look at that. What a start. And before you know it, activity-based costing relating to budgets is a lot easier. So that's question 1. Hopefully got on all right with that. So let's now move on to question number 2. And again, as you're going through, try and go through it yourself. You're going to get a lot of benefit out of practicing and then reviewing the answers with me on here. So let's again just walk and talk it through. So the selling price of product X, so try to picture product X in your mind, is actually set at $550 on this. So the selling price, $550, lovely. And sales for the coming year are expected to be 800 units. So automatically I'm thinking that, right, 800 units multiplied by 550 is going to give me my total sales revenue. And then the return of 30% on the investment of 500,000 of product X will be required in the coming year. So when you think of return on there, you think of actually the profit after all of the costs, that they're wanting a 30% ROI on this. So it's asking, what is the target cost for each unit of product X to 2 decimal places? That's a key thing on there, 2 decimal places. If you don't put it to 2 decimal places, or you put it to 3 or 4, then you're not going to fulfill the requirement. So again, have a little attempt through it. I walked and talked it through as to what sort of elements it's bringing up on here. And then we can review it and see how you get on. Right, 3, 2, 1, let's have a look. So let's walk and talk this through and what it all means broken down. So as to start off, we've got to look at the return, what we're looking for. So it says there $150,000, which is spot on, but as a different way of wording it, think of it as the overall profit now. Okay, so that's 150,000 profit that we're looking for, the return of this actual project with product X on here, we're looking for 150,000. Now we get on to that total sales revenue, the 550 multiplied by the 800 units, okay? So in essence on here, what you've got to say to yourself is, the total revenue, this was the sort of game changer if you got this right or wrong, the total revenue minus the profit is therefore going to equal your total cost. And as you can see on here, the actual 440 minus the 150,000 gave us $290,000. That's the total cost that we are allowed, in other words, to say, look, if we sell all these products for 440,000 and we have total costs of 290,000, we will make that return on investment at 30% of $150,000. But the final thing on here for the unit cost was 290,000 divided by 800. Okay, so this is where we can pull out the calculator on here, as you can see. So just be crystal clear as you go through it. Okay, so you got your 290,000, as you can see on here, divided by your 800 units. So doing it exactly if I was in your shoes on here, press enter. Now, can you see on here how we've got it to 0.5? Make sure you put in that 0 at the end. Remember, we want 2 decimal places on it. So that's the 362.50. So there we go, 362.50. If my actual 362.50. Spot on. Lovely stuff. So I hope you got that right, along with the actual narrative. So make sure you're getting down some good notes on the side. So if you see more questions like this, you're going to get them right. They're nice, easy marks to pick up on. So nicely moving on to question 3 now on here. Okay, so we've got a couple more products on here again. Standard sort of PM sort of question. So let's have a look at the bottom on the requirement before we get into those figures. So if only product P1 were to be made, okay, so just a sort of product P1 focus, how many units would need to be sold in order to achieve a profit of $60,000 each year to the nearest whole unit? Okay, right. There is a game changer sort of formula. If you know it, then you're going to have a really good attempt at actually answering this question. If you don't know it, then it's going to be very, very tough. So what you can do now is, have an attempt as we go through, and I'm going to walk and talk you through it. But, okay, pause the video, and you're back, right? So, the key formula that you needed on this, really, before you even get going on the question and analysis, was that the fixed cost of the actual operation for this, so specific to P1, plus the $60,000 in the actual target profit, divided by the actual contribution per unit. That's the key formula. If you didn't know that, then you're really going to struggle on this. But let's walk and talk through the actual question here. So PCO makes two products, P1 and P2, as we can see aligned on there. The budgeted details for each product are the following on here. So we've got the selling price, so nice and easy stuff on there. Lots of expenses with the profit per unit at the bottom. Cool. Budgeted production and sales for the year ended 30th of November 2005 are, okay, so product P1 that we need to focus on, 10,000 units. Product P2, 12,500 units. Okay, lovely stuff. Now, what's the statement down here? The fixed overhead costs included in P1 relate to apportionment of general overhead costs only. However, P2 also included specific fixed overheads totaling 2,500. Now, when I read that for the 2,500, the question I have to ask you is that specific to if we only made P1 on there? Or is it a case of that $2,500 is, well, if we go through a P2, we're going to have to incur it. So have a go at the answer, see how you get on, and again, we'll just sort of walk and talk it through. Pause the video now. Right, as ever, the important stuff's going to be up here. Let's review it through. Now, proper stuff. Let's go through it one by one. So if you haven't already, get that formula for the target profit jotted down in order to work out the number of units required to achieve that target profit level. And again, remember, focusing back onto just P1. So then you need to go through it and say, well, if we're going through, and this is where the mistakes would have been made on this question. I know it says only for P1 were to be made, but the key thing to get jotted down here is that if we only make P1, okay, we still have fixed overheads, okay, that are relating to P2 that we would have to incur. So imagine you've got that factory and you've got P1 and P2 in there, and your boss comes down and says, look, we're only going to do P1 today, and that is all it is. Well, we're still going to have to cover those P2 actual fixed costs. The bit, as you can see on here, minus for the 2,500 is if you were to go through and make some P2, okay, so think about that $1, it may be this $1 here where my mouse is, that maybe that's for the actual manufacturing costs that, or the actual storage of it potentially, or the warehouse cost for it, that even though we don't make any P2 products, we still have to incur. But the 2,500 is if we actually make one P2 product, then we would have to incur that 2,500. So that is why it's deducted. But the figures have all come from this fixed overhead actual line on here. So the 1.2, and this is where it's really key that we actually analyze which level of units. So product P1 we had 10,000, so $1.20 multiplied by 10,000 plus the $1 here multiplied by the 12,500, deducting off the 2,500. Okay, so that there is our fixed cost figure for the actual production. And then you've got to say to yourself, well, I've got to work out now the denominator, the number at the bottom of the fraction, and that is our contribution per unit. Now, there are two ways to get this down, okay? So the first one, as you can see on the screen, that ACCA have provided, is quite simply saying, and again, remember, it's relating to just P1, £3.20 for the profit for the year, and on the fixed costs, okay? Or the fixed overhead in this case. There is another way. Okay, the way that I was used to get taught, and I teach my students on it as well, is quite simply, if you take the actual selling price of the product, less all the variable costs, you are going to get the contribution per unit. So in other words, to get this $4.40, the $10 here, minus the $3.50, minus the $1.50, minus the variable costs, is going to get you the same figure. So whatever works best for you, pop it down in your notes, it'll help you out either way. Now, as you can see on here, we've got the 22,000 plus the 60,000 for the target profit divided by the 440. Now, I've got to show you this. This is really important on here. Okay, so imagine you're going through it. Well, I'm going to go through it as if I was you. So you've got to go through, first of all, and pop in the 22,000, add on the actual 60,000 on here. So there it is. Make sure you get the right brackets on it, the right number of zeros as usual, and then divided by the 440. So taking our figures on here and then enter. Right, important stuff, because this is where potential mistakes will be made, okay? So if you have a look at the actual requirement at the bottom, it says to the nearest whole unit. Now, this is where things may differ, and I have an opinion and others have an opinion, but as per the requirement, it's asking to the nearest whole unit. So this is really key to get it down. Make sure you analyse the requirement effectively on here, because imagine this is saying 18,636 units, 0.36 units on here. Now, in order to actually achieve a target profit of 60,000, if you only make 18,636, technically your profit will be just a touch under 60,000, okay? So logically you'd say, well, James, if we made 18,637, then we'd hit the target profit and would be slightly over. I agree with you. However, as per the requirement down here, it says to the nearest whole unit. So as we're under, if it said 0.4 on there, we'd have to still round it down on there. If it said 0.5, you'd have to round it up to the nearest whole unit. So please, 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 just make sure you get that jotted down in your notes, because it could be the difference between getting that extra little mark or not. Okay, and relax as we go through. But this is what I think when I review these past papers on here. What would I be thinking if I was in your shoes? So that nicely takes us on to the next question on here. And as ever with a sort of performance management CBE, you're going to have calculations, you're going to have wordy questions. So the more practice you do on these, the better. So as you can see on here, which two, notice how it is actually in capitals. The reason for this is some students only put one. If you put one, you're not going to get the marks. Which two of the following statements regarding environmental cost accounting are true? Okay. Now, for ease on this, and I don't want to give away anything from the way I say it over to you, if you want to pause the video, pause it now, and then I will go through and actually walk and talk it through, and then we'll review the answer on there. Okay? So, come back. Now, the majority of, so we're looking at through the answers on here, and again, just reframing it back to me, regarding environmental cost accounting are true. So read these through and think to yourself, is that actually true? So the majority of environmental costs are already captured, read the question properly, James, within a typical organisation's accounting system. Okay, that sounds reasonable to me. The difficulty lies in identifying them. Okay, as the first one goes, okay. Second one, input-output analysis divides material flows within an organisation into three categories. We've got material flows, system flows, and delivery and disposal flows. Okay, weighing it up on there. I'm edging a bit more on number one first of all. One of the cost categories used in environmental activity-based costing is environment-driven costs, which is used for costs which can be directly traced at a cost centre. Okay, not to give it away, but finally on here, environmental life cycle costing enables environmental costs from the design stage of the product right through to the decommissioning at the end of the life to be considered. Okay, that sounds all right to me, but let's have a look on here. So let's pull it up. I'll get it down here. Now, the first thing on here is it doesn't actually tell you directly which one on here. It gives you an explanation. But I can tell you now on here, the top two are correct. And they relate to these two on here. So let's just walk and talk it through. So it says on here, most organisations, and I'll tell you why they're correct on here as well. Plus, when you read them through, you go, that can't be right. Most organisations do collect data about environmental costs. So as you can see on here, the majority of environmental costs are already captured. So that's where it links into there. But find it difficult to split them out and categorise them effectively. i.e. difficulty lies in identifying them. So hence that is a true statement. The next one on here is life cycle costing does allow, okay, the organisation to collect information about a product's environmental costs throughout its life cycle. So in other words, and the key thing to get jotted down here was design stage. So imagine if you set up your own business with your own product line. It starts off in the early stages, it goes through the actual design stages, all the way to the sort of growth and other areas on there. And this is where potentially decommissioning at the end should be considered. So that's the key aspect on here. Then we go on to, we've got the input-output analysis. So the technique which divides material flows into three categories is material flow cost accounting. So this links it into the actual question on here. Not input and output analysis. So that's just a little fact about actual performance management that meant it wasn't true. Finally on here, we've got the actual activity-based costing does categorize some costs as environmental-driven costs. However, these costs, which are normally hidden within total overhead, so they're sort of bunched in together in a conventional costing system. It is environment-related costs which can be allocated directly to the cost centre. So, as you can see on here, one of the cost categories used in environmental activity-based costing is environment-driven costs, which is used for costs which can be directly traced on there. That was the key thing. Okay, so this is where we're talking about allocation. That's why it wasn't true as a result. So it's talking about in a conventional cost system on here and how they are hidden within the total overheads rather than being directly traced. So that's why that statement is actually false. How it's basically being allocated and categorized on there. Lovely. So that is question 4. Let's walk and talk. Hopefully getting on all right so far. Stay with me. Let's get on to number 5 on here. So what have we got on here? Well, we've got, based on the above information, I'm going straight to the requirement, which of the following statements is true. Now, because we've actually got a pull down tab, make sure you have a little look, first of all, on here. So this gives you an indication to potential actual calculations that you need to be doing, okay? So straight away you can see variances are included. We've got the total mix variance on here, and we've got adverse and favourable. So in other words, we've got to be working out what did we say was going to happen and what did actually happen, and then working out the variance. So are we in a more favourable position or adverse position? So what we'll do is I will walk and talk you through the actual answer on here. Actually, I'll walk and talk you through the question, then you can go and attempt it. But I've given you a little flavour for how to actually go about it. So in essence on here, so to produce 19 litres of product X, so try to picture on there 19 litres, maybe in barrels or bottles, whatever it may be, of product X, a standard input mix. So in order to make those 19 litres, a standard input mix of 8 litres of chemical A, so that's the first variable on here, and 12 litres of chemical B is required. So the actual input is 20 litres, and then that produces 19 litres of product X. Chemical A has a standard cost of $20 per unit. Chemical B has a standard cost of $25 per litre on here. During September, the actual results show that 1,850 litres of product X were produced, right, that's going to be key, using a total input of 900 litres of chemical A and 1,100 litres of chemical B. Okay, so we've got what's actually happened here, and the actual cost of chemical chemicals A and chemicals B were at the standard cost of $20 and $25. So that final line on there is telling you that there is no actual change in the price. There's no adverse or favourable effect on here. So what you've got to be focusing on is the actual standard input mix on here, and we've got to work it out for saying both of the variances were actually adverse or favourable, or the total mix variance. So straight away there, you've got to be thinking of, well, the actual quantity standard mixes as well. And then we've got the giveaway was in the yield and the actual mix on here. So that's a really nice little tell in the answer how you should actually go away and actually approach this question. So again, as ever, feel free to pause the video, start to have a little work through, and we'll review the answer top to bottom, and you will need to use the calculator on this not to make any mistakes. So have a little go on that. And we're back. So let's go through the actual answer for you now. Now I'll walk and talk you through the actual figures on here. So let's get it over to the side there. Now, this is where you've got to pay real attention to the figures as we go through. So as you can see on here, we've got the actual quantity standard mix, so the AQSM, and then we've got the actual quantity actual mix on here. So let's break it down as a result on here and understand where these figures have come from and what it means to you to interpret them. Okay, so first of all, we've got to come on to the actual quantity and the actual mix. Let's stick to the figures that we know are true on here. So first of all, we've got to say, well, what actually happened? Well, we had 900 litres of chemical A and we had 1,100 litres of chemical B. That's what actually happened. So there's your 900, there's your 1,100, giving us a total of 2,000, okay? But then you've got to say to yourself, well, from the information we were given, okay, at the start, what would we expect from 2,000 litres? What would be the actual split on here? So the actual quantity for the actual standard mix. So if you've got 2,000 litres, imagine that 800 and 1,200 isn't there. And I said to you, you've got 2,000 litres in total, okay, from this actual standard input mix. How much of that 2,000 litres would you expect to be chemical A, and how much would you expect to be chemical B? And this is where it comes on to the 8 litres here and the 12 litres here. So all it's saying to you there is, and I can get technical now and pull out the lovely calculator on here. So all you're saying there is, for the actual, let's keep the requirement all on there. There you go. Well, if I get cut off on my head on the side, it'll be all right. So you've got the 2,000 on here. So there's your 2,000. And then, so to produce the actual standard mix, there's 20 litres altogether, as we said. So divide it by 20. Lovely stuff. And then we'll times it by 8 for products, for chemical A on there. Lovely stuff. So that is where the 800 comes from. You do the same, instead of multiplying it by 8, you do it by 12, and that gets you the 1,200. So in essence, as you can see on here, you're asked for the differences. Remember, the actual standard cost per litre hasn't changed on here. That's the first key thing. So then you've got to say to yourself about the actual differences. And this is where a student who's going to pass this exam really flourishes, because we're going to take literally the figures we've talked about on here and then say, well, okay, well, what were we expecting to have versus what we actually had? And we're saying here that, well, we expected to have 800, but we actually had 900. So this is where we had 100 difference in terms of the number of litres for material A, and that's where we had an adverse effect. So hence the actual 100 multiplied by the 20 gave us a total adverse variance, okay, for $2,000, whereas we actually had a favourable amount for material B, and because that is at a higher standard cost, overall that gave us a favourable variance, okay, for the actual mix in terms of the actual standard input, and there was a little clue up here in the actual question. So it's just getting a bit more savvy on these as you go through it. And the more practice you do as ever, the better you're going to become. Now, as you can see, the mix and the yield, and I'm hoping as we pull this down, no, it's underneath there, but the mix and the yield variances were actually given to you in the question as well, and for the answer, should I say. So that was another little actual trick and tip for you on here. But now you've got to say to yourself, well, we've got to work out from our actual 800 and 1,200 what sort of actually happened on here. So we've got to say to ourselves, well, from the actual or the results on here, the litres of product X that were actually produced, and again, I'm just going to clear off the calculator so I don't make any mistakes. I'm then saying to myself, well, of these 1,850 litres, they are in sort of batches of 19 litres. So how many 19 litres are in 1,850? Okay, so divided by 19, as you can see on here, that's going to give me 97.36, okay? And then all I'm going to do to that is then multiply it by 8 and multiply it by 12. So multiply it by 8 on there equals 2, as you can see. So, and this is where it's really key on here for just to be careful on the rounding. So you got 778.94, so that'll round up. So there's your 779, as you can see down here. Do the exact same on your calculator, but instead of multiplying it by 8, multiply it by 12, and you're going to get that figure for 1,168, okay? And then you say to yourself, well, from the, actual quantity, from the standard mix that we expected, well, what did we actually have? And well, we are actually expecting to produce 800, but what we only got out of it was 779. So that is where it is adverse. The same happened for material B, where we were expecting 1,200, but we only got 1,168. Again, another adverse. So that is where we get overall, again, applying the standard cost, as we talked about, $20 and $25 a litre, respectively on there. We then came for an overall for the yield variance, and again, I'll pull down the calculator here so we can get rid of it. So the yield variance on here, just to be crystal clear so that you understand the sort of terminology behind it, we actually had a adverse variance, whereas for the actual mix, and again, I'll come back to the answers on here, notice we had mix given in here. So that was a little hint to say you've got to be doing a mix variance, and then you can see on here for the total yield variance. So for ours on here, we need to select the actual bottom one because the total mix variance was favourable, 500 favourable in that total there. And the total yield variance was adverse, adverse by 1,220 on there. So I would definitely be selecting that one with that sort of explanation as a result. So you've got the little workings that you could have done at the bottom on there, a different way, but for me that is the easiest potential way, along with that 1947 is simply just the actual total there. Okay, lovely stuff. So that is question number 5 on there. Let's hop over to the next one on here. So what have we got on here? And this is where you're getting into the actual exam. Your concentration may be going up and down a bit on here. Where we've had numbers questions, and now we're getting wordy questions as well. Where you think, oh, all I've got to do is simply move 6 boxes. This should be a no-brainer, an easy one. Well, it's where you really have to focus down as to what it's actually asking for. And this is where, if you haven't looked at the core text on these key areas, these are the different types of budgeting. And we're being asked on here to match each of the following statements to the correct budgeting process. So in other words, these boxes here, as you can see that go blue, have got to go in one of these on here. And it's put up here, a budget is a quantified plan of action for a forthcoming period. Okay, nice. Budgets can be prepared using a variety of approaches, as you can see down here. So again, pause the video, have a little go at it yourself, or write it down, pen and paper, whatever works best for you. And then you can actually take it through and see what answers you get. So pause it now, and then we're going to go through and review it on there. Okay, so let's just walk and talk through the actual ones on here. And as you go through these sort of 6 examples, try to work out which ones are just the no-brainers. It has to be, because you definitely know it. And then we can just sort of work out by sort of trying to say to yourself, well, is that the correct one on here? And then we'll review the answers. So let's walk and talk through the question. So we've got beyond budgeting, incremental, activity-based, rolling, flexible, and zero-based on there. Okay, so some you'll recognize, some you may not. It's okay, don't worry. Now, on to the next clues in the statements. So statement number 1, builds in previous year's problems and inefficiencies. Okay, and don't be, if you're thinking through this, oh my word, James, I think it could be one of the two. Don't worry, we're going to narrow it down. It's okay. So as we go through here, we've got to say, well, recognize different cost behavior patterns. Okay, cost behavior on there. Next one, focuses employees on avoiding wasteful expenditure. Okay, so wasteful on there. Next one, we've got focuses on controlling the causes of costs. Okay, so automatically I'm thinking to myself, if I've had a look at budgeting, a couple of these will stand out to me straight away. And we've already seen one which I particularly used to enjoy on this module, shall we say. So we've got focuses on the controlling the cause of the costs, always extends the budget 1 year into the future. Okay, so we're looking at the future here. And then finally, using adaptive management processes as a result. Okay, so have a go, allocate them over, and 3, 2, 1. Let's have a look on here. So this is where it breaks it down for you. So hopefully I might be cut off, but it doesn't matter on here. It's just so you actually get a bit of a feel for it as to, which one should we select and why on here. So we've got beyond budgeting actually attempts to move away from conforming to a rigid annual budget and uses adaptive management processes to encourage management to be responsive to current situations. And the key word on here was management as a result, so on there. So for our beyond budgeting on here, we need to look for something involving management, as you can probably see on here, uses adaptive management processes. So little notes to get away from here is beyond budgeting, management processes I definitely have down. The next one on here, incremental budget, as you can see, builds in previous year's figures, and so any inefficiencies will be carried forward. So builds in previous problems and inefficiencies, as you can see on there. The key word was previous, as you can tell in my voice, I'm trying to highlight. The activity-based budget, okay, or budgeting, should I say, is all about based on the principles of activity-based costing. Okay, so we've seen that before in question 1, and we'll attempt to identify the drivers of costs in order to actually formulate this on here. So it's all relating, and actually costing will be in here, but then you think to yourself, well, okay, well, recognizing different cost behavior patterns, does it relate to that? And then we've got, focuses on controlling the causes of costs on there. So let's come back to that, because you go, hang on, not particularly sure, I'm going to do this through as if I was you on here. And then we can actually narrow them out on here, because we've still got 3 more options. So we've got the rolling budget, okay? So rolling budgets are budgets which are continuously updated, okay, hence rolling on it, throughout the year by adding a new budget period once the most recent budget period has ended, okay? This means that the budget is always extended 1 year into the future. So that's a real good giveaway on there. So extending is the real key one on here, as we can see. Means that the budget is always extended 1 year into the future, and so forces management to reassess plans more regularly. So as you can see on here, always extends the budget 1 year into the future on there. So hence, rolling 1 year into the future, okay, and then we're narrowing it out, because activity-based budgeting, we're going, okay, well, it's going to be the 1 and the 2 on here, so let's keep it going through, and then we'll work it out. So then we've got on here, flexible budgets are designed to show changes in financial figures based on different activity levels, and so we'll recognize different cost behavior. Seen that before, nice. And now we're eliminating out ones on here, really good exam technique. So it recognizes different cost behavior patterns, pop it down there for flexible. Zero-based budgeting, as we can see on here, I'm just going to make it a touch bigger, lovely stuff. Zero-based budgeting, ooh, there we go. You can tell I'm good with this. Zero-based budgeting starts from scratch with each item justifying for its inclusion in the budget, and so should encourage the identification of waste and non-value adding activities. So straight away, wasteful on there for zero-based. Hence, as we were talking about costing on there, So focuses on controlling the causes of costs. Lovely stuff, activity based on there. So really just little techniques how we can actually narrow it down with highlighting the actual keywords and key terms that you've got to get down in your notes, because budgeting is more than likely going to come up on this exam, a highly examinable area. So that's number 6 on there. Hopefully we're all getting on so far so good. All right. Oh, okay. So we've got obviously a decision tree on here. Question 7. So what are being asked? So using the information below, identify by clicking on the relevant branch. Okay, so it's either that one, or that one. Which action the company should take. So this is the actual decision that we're making. These are the outcomes. So the branches are one of these 3. So it will probably be a little X. Okay, lovely stuff. So you've got to put that X over which one you think it is going to be. So don't go putting the X over here somewhere. You're not going to get any marks for that. You've got one of 3. And make sure it's on the line. So again, as ever, let's put the X up there for now, out the way. Let's have a look through this. And again, I'll just go through the question review with you. I'll say keep it simple. So a leisure company owns a number of large health and fitness resorts, okay? But one is suffering from declining sales and is predicted to make a loss next year, okay? So one of them is a loss maker. As a result, management has identified a number of possible actions. So this will relate into the actual decision tree at the bottom here by identifying the relevant branch. So option 1, shut down the resort and sell off the asset. So that's the top one there. Undertake a major upgrade to facilities costing 4.5 million. So there's major upgrade there that we could select. Or thirdly, undertake a minor upgrade to facilities costing 2 million on here. So the upgrades are predicted to have variable results. So this is where it comes down to here. Whereas if you just shut down and sell, that's going to be the positive cash flow on there. As we can see, and the probability of good results after a major upgrade is 0.8, whereas the probability for good results in a minor upgrade, so this one here, is 0.7. Okay, the company is risk neutral and has prepared the following decision tree. Okay, lovely stuff. I think we can have a good attempt on that. We've been given some sort of outcomes, we've been given some costing and potential results, as you can see down here. So as ever, pause the video, have a go at it, and then make sure you select or write down which actual tree you would identify on here, or should I say the branch associated with it. Okay, so 3, 2, 1. Let's explain the answer on here now and where we would go about it. So I'm going to pop it up here and then hopefully we'll move it across as well. Now, the key thing to get down where people will make mistakes on, and in fact we'll go back to the question first of all, is this 0.8 here, okay, and the major upgrade. So this is where you have the major upgrade and the minor upgrade, but then you say, well, it's got 2 different potential outcomes on it. So if you've got the actual major upgrade as a 0.8 of good results on here, so we're going to multiply that by the actual 11 million. So I'm going to cut me off for now on here because the answers are more important on here. So there's 0.8 of the probability where the actual major upgrade has a good result. So you go major upgrade, good result, 11 million, probability of that is 0.8. So then you say to yourself, well, if we have a poor result for 0.75, the probability of that, would you agree, is then 0.2. So that gives us our total actual value for this project, for the actual major one on here, of 10.3 million, okay? Or the expected value for the EV. Then you're going to say, okay, well, on to the minor one, and we have a different probability here of 0.7, and take 0.7, so go down the branch, good results of 9 million, well, the probability of that is 0.7, so we add that to, well, if we go down the branch again, and we have a poor result, that's going to cost us 6 million, so multiply that by 0.3, as you can see. So this now nicely links into your actual decision as a result on here to say, well, which actual inroad should we go with, okay? And it's saying on here to say, well, what would be the actual benefit on here? So linking it back to the relevant branch, which action should they take? So if we shut down and sell, as you can see on here, we're going to have a positive cash inflow of 5.75 million. If we actually go through the major upgrade, and we have 10.3 million, so our figure pulled from here is going to be our positive cash flow. But this is where people will make mistakes on this, there are costs associated with it, which are up here. Did you forget it? And you have to deduct that off, the 4.5 million in this case, so don't get them mixed up. So the 10.3 million minus the 4.5 million gave us a net amount of 5.8 million. But finally, as you can see on here, the 8.1 million, as we worked out above up here, minus the initial cost, so to undertake that actual facility to go through, gave us an actual net positive return from the minor upgrade of 6.1 million on there as a potential result. So as the minor upgrade has the highest expected return, that should be the option chosen. So on there, so we want to go to the minor upgrade, and we just indicate it just nicely on there. That would be the one that we would go through as a result. You can see why people make mistakes on this exam, can't you? Lovely. Well, that's number 7 on there. And this is where we get on to number 8. And again, I've just scrolled down there, but make sure you actually analyse all of the question. But you can see on here, we've got to actually rank the products on here, A, B, C, and D, A, B, C, and D. And we've actually got to have a look at rank the products in order. They should be manufactured, assuming the company wants to maximise profits in the next 4 weeks. Well, okay, well, I'll give you a little hint on there as to anything in, and get this noted down in your notes, this is really important, anything in performance management where you see maximising profits, you've got to be thinking straight away contribution per unit. So, as you can see on here, let me just walk and talk you through the question. We've got the 4 products, we've got to rank them. In other words, quite simply, if you were asked tomorrow to go and make these products in an order of make all product D, then C, then B, then A, it's got to be on the basis of the highest potential contribution per unit. So then you say, okay, well, a company has the following production plan for the next 4 weeks. The figures reflect the full capacity, so we're at full capacity from the operations. Planned output is equal to the maximum demand per product, okay? So we're going to have, we've got planned output on here, we've got the number of direct labour hours, so that's going to be critical on here, because it has now been identified that the labour hours available in the next 4 weeks will be limited to 4,000 hours. So it's a limiting factor question. So that's a nice little question overview. I'm going to have a sip of coffee, have a little read, and pause the video if you want to have a go at it yourself. Pop them in the ranking and with any workings. Then we'll review it. Okay, so we've got to be paying attention to these figures up here, but straight away you've got to be thinking, well, I've got to be looking at the actual direct labours per unit and also the profitability. So, well, I mean, look at D. D is a dead cert because we've got a profit of 48, which is the highest, and also it's got the lowest amount of direct labour on there. So that's looking like a no-brainer before I've even looked at any calculations, and it's going to be a sort of pick and mix on here between, well, product B is quite high, but look how many hours it takes to actually make. So that's going to be a real factor or a little sort of insight on there. So let's have a quick look on here. How was my hunch? So in a single limiting factor situation, products should be ranked based on their contribution per unit. Get that jotted down, it's in the answers as well, of a limiting factor. So limiting factor question, which is the labour hours, and that is 4,000 hours, as you can see. So I've just moved it across on there. Now, key thing on here is working out that contribution per unit as a result. So as you can see on here, we've got, quite simply, we've got the actual, I'll move it over here so we can get the calculator out so I can show you on the screen. So nice and easy, we'll just do product D first, because as you can see on here, the ranking that was first, look how much higher that contribution is. But you could see that generically from the figures, couldn't you? Because it had such high profit and such low labour hours. But the key figure you need to now work out is that 60, the 21, the 52, and the 46. So quite simply, as we had from the previous video, so if you haven't got it jotted down already, selling price less the variable cost is going to give you your contribution per unit. So there's your 140, and I'm just taking it there from the selling price, and then simply minusing off the 40, the 22, and then the 18. So minus the 40 on there, minus the 22 and minus the 18. Lovely stuff. So that gives us down to 60 on there, and that is our 60 here. Follow the same process through for A, B and C, and then that is going to get you the workings for it. Then you've got to ask yourself, well, what is the limiting factor? And this is where the labour hours really key to identify is that we had 2 for number D, 3 for C, so this is where the figures are coming from, 6 and 8. And then all you simply do is divide one by the other. So 60 divided by 2, 21 divided by 3. And the highest, okay, the highest contribution per labour hour will be the basis of how we actually rank them. So as you can see on here, let me move the actual tab back over because we're going to select our answers now. The first should be D because it was 30. The second should be A because it's 7.67, so slightly higher than C. So then we want A for second, so make sure we're dragging and dropping these correctly. Third we want is C. And then finally on fourth we want B. Lovely stuff. But it all came from identifying in this question that maximising profits was the key thing. And that was the trigger to go on and actually use the actual contribution per unit with the limiting factor. So lovely stuff. Another mark in the bag, or 2 marks should we say. Right, what have we got here? And again, you think to yourself, oh gosh, we've only got 3 boxes to allocate, James. Probability on this, we should get this right. So we've been asked to match the correct value for money performance category to each of the following targets of DEFCO. Okay, so we've got value of money performance categories. We've got economy, efficiency, effectiveness, and then we've got the actual parameters on here for the target. So increasing the number of chargeable hours handled by advisors to 6.2 per day, obtaining a score of 4.7 or above on a customer satisfaction survey. Okay, so try and quantify these in your mind, how we would actually measure them. And then finally, cutting department expenditure by 5%. Okay, nice. Let me review the question for you, as ever. So DEFCO, so as we've been talked about in the actual requirements, provides accounting services to government departments. Okay, so it's a nice third-party provider. On average, each staff member works 6 chargeable hours per day. So straight away I'm thinking, well, they're wanting us to increase that from 6 to 6.2, so that's a human factor on that, with the rest of their working day spent on non-chargeable administrative work. Okay, nice. So 6 chargeable hours is our benchmark on here. One of the company's main objectives is to produce a high level of quality and customer satisfaction. So hence there's the customer satisfaction, and quality on there, cutting the actual expenditure would probably link into that. So DEFCO has set its targets for the next year. So in other words, you've just got to link it over to say, well, from these performance factors, what do they link into each category on there? So as ever, pause the video, have a little think about it as well, which one you to go through, and then we'll review it together as a result. But my little hint would be, think about it from a business perspective, monetary perspective, and measurable perspective. So, 3, 2, 1. Here we go. So this is what you should have hopefully got as a result. So target 1 is, okay, so this one over here is measuring the rate of work handled by staff as an efficiency measure on there, okay? Then we've got target 2 is assessing the actual output, so it's a measure of effectiveness as a result. And then target 3 is a financial measure as it affects actual economic factors on there. So you've got to work it through and just say, well, okay, well, how does this actually relate it into? So target 3, as you can see down here, cutting the actual departmental expenditure. So this is a financial measure, isn't it? We're looking at a percentage on here. So that is going to be an economic factor as a result for target 3. And then we've got to say, well, obtaining a score of 4.7, okay, so it's assessing output and its effectiveness. So how effective are we in a satisfaction perspective with our actual customers for their satisfaction from the services that we provide to the actual government on here. So, okay, effectiveness will go on there. And then finally on here, efficiency. Well, this is a sort of people side, sort of social aspect with employees going about their day. And this is not monetary because it's involving people, where you're trying to increase their productivity up from that 6 hours of chargeable time a day to 6.2. So they've got to be more efficient on there. So it's just going away from this one, making sure you're crystal clear on what each of those areas relate to. So have a look back on your core text, especially on there, because it could have been quite easy to mix some of those up, especially. Nice. So let's have a look on next to the next question. Okay, we've got another box one on here. So again, let's review it as we go through. So we've got different characteristics relating to different systems on here. So we've got executive, enterprise, transaction, and management information system on here. So question 10. And then we've been asked that different types of information systems provide the information which organizations need: strategic, management, and operational control. So there's little hints in there what they're trying to actually get you to think about here. Match the following characteristics to the relevant information systems on there. So what have we been given? Summarizes internal data into periodic reports, okay? So I'm thinking now who's going to actually use these out of the 4 on here. Can be set up with extranet links to customers and suppliers. Okay, well, that sounds very enterprisey to me, if you ask me on there. Then we've got to think about, well, we've had periodic on there, which is sort of, you know, quarterly and yeah, well, actually, I don't want to give the game away because you've got to have an attempt at this. This is what I think when I review them. It utilises dashboard facilities and interactive graphs, or graphics, should I say. Well, I mean, yeah, that's I'd say you should get that one. Facilitates the immediate processing of data. So if you want to, as ever, pause the video now. We're on question 10 on it, and we'll have a little review on this as we go through. Right, let's have a look through on this then. Wow, as I'd have said straight the way through, executive on there, they're always into interactive graphics, I would say, as a result. And the sort of enterprise, I'm expecting to see the customers and suppliers. They are external factors on there. So let's pull up the answers so you can actually see them as we go through. Sorry, it's half cut off on here, but let's have a look through. So we've got the actual transaction one first of all on here. So transaction processing, as you would expect. I mean, trying to think about this from a common sense perspective. Transaction processing systems facilitate the immediate processing of data. Okay, so as you can see on here, we've got it on here, transaction, immediate processing of data, nice and easy one, okay? Management information systems summarize data from TPS into periodic reports for management for use of decision making. So there's management, there's periodic. What that means for periodic is, imagine you're in a managerial position, you may want quarterly reports, you want your half-year statement, you may want the annual report, and then you can make those decisions based on it. That's where you've got to think it through in that manner. The executive information systems draw data from MIS and support senior managers to make strategic decisions. Again, the clue is in the question. They usually have dashboard and interactive graphs so that the big picture can be seen. So imagine you're an executive, your time is really short, you want to see how these things are actually progressing on a graph or interactive graphics on here, which nicely leaves, as we said, the enterprise resource, customers and suppliers. As you can see on here, we'll go through the answer, might as well. Enterprise resource planning systems are software packages that integrate all of the key processes in organizations and also permits data to be shared more easily between departments. It can also have extranet links set up by customers and suppliers on there. Nice. Whew, in the back, another 2 marks. Nice. So let's get rid of that. Hopefully you're going all right so far. Stay with me. We've only got a few more to go now. Really good question practice. Again, keep pausing the video, keep having a go, and I'll keep explaining them. Oh, I mean, you look at this and you go, well, I've just got to select 2 James for 2 marks. Well, let's make sure we get it right on here. So question 11, okay? So which 2 of the following are examples of direct data capture costs? Okay, and again, I'll just review the question with you. So using barcoding and scanners, Use a chip readers to read data from chips on customers' bank cards when paying for goods. Payroll department processing time of personnel costs. Email sent to staff on matters that do not relate to them. Okay, so again, pause the video on here. I'm going to have a sip of coffee. And then remember, we've got to select 2 on here. So don't select 1, select 2, and then just try and work it through. But the key phrase on there is direct data capture cost. Right. So, first things first, get these jotted down. Direct data capture costs always refers to actually it going through directly on there. So there's no actual manual typing in as a result. So hopefully that'll not impact you on your actual answer on here, or what you put down, should we say. So let me pull it on for you on here. So in other words, no data entry is the key thing on here. So direct data capture is a type of data input in which there is no data entry, but instead uses electronic means. Therefore, the use of barcoding and scanners and the use of chip readers are examples of actual direct data capture on there. So we had the barcoding, lovely stuff on there, and the use of chip readers. So there was the chip readers on there. But it's always good to understand why the other answers weren't correct. So the time spent by the payroll department processing personnel costs is an example of a process cost on there. So it's think about them actually directly inputting it into the actual system for the individual employees to pay them for the payroll. The sending of emails to staff regarding matters that are not pertinent to them is classed as an inefficient use of information costs. Yes, so again, they're directly putting it into the system to actually fill the role that is required. But key thing to get down, if you haven't already, no data entry, all electronic on there, electronic means. Remember that, you're going to be fine for this question if it comes up again. So, lovely stuff, we've got down the right answer. Let's head on to there as well. Oh, again, right, another one involving 2. So which 2 of the following statements regarding the life cycle costing are correct? So same process you go through, try to eliminate the ones that you go, that is just no chance of that absolutely coming up at all. So that's the means as we'll go through. So let's have a look at the question analysis on here. So which 2, as we go through, life cycle costing are correct? So are they true relating to? So it can be applied not only to products, but also to an organization's customers on there, okay? Next one we've got, often between 70% to 90% of costs are determined in the actual product life cycle on here. Thirdly, it includes any opportunity costs associated with production. And then finally, the maturity phase. So there are sort of little tells in here as well to say, well, we've had maturity phase in here. The maturity phase is characterized by a rapid build-up in demand. So we've got product life cycle costing on here, okay? So again, pause the video as you go through. We're on question 12, so we're nearly there. Have a little attempt through, and remember, you've got to get down 2 answers on there. So what are we going to be thinking of which ones are correct and which ones aren't on here? So it can be applied not only to products but also to the organisational customers. I would say that is going to be spot on there. And then often between 70-90% of the costs are determined early in the product life cycle. Well, yes, pretty much, because imagine all that sort of groundwork as you go through to actually build up the actual product itself in the early stages, and then it's going to go into the different levels of the cycle further on. Because as we come on to the actual explaining the example on here, so I'll just give you a moment to actually get that down, but we actually got we've got the maturity stage, we've got the design stage and the growth stage, and we actually had maturity phase on here, or stage, whichever one you want to refer to it as. Really key indicators, but we'll just work it through on here. So customer lifecycle costing can be used by organisations. So as we've got on here, relating to customers, it's been reported that the majority of products costs are determined earlier on at the design phase. So that's where you're ploughing in cash to the business, and then you're hoping long term it's going to generate positive cash flows. But the initial outlay was in the earlier years, or determined in the earlier of the product life cycle on there. So hence that large percentage of cost. Then we go on to life cycle costing does not include any opportunity costs associated with the actual production. So the opportunity cost is what they could have done otherwise from going through with this. So they're lost out of, and they're not actually considered. And then finally, the growth phase is characterized by a rapid increase in demand. And we had it down here, the maturity phase. So it's the different area on the curve as a result. So it's just understanding growth phase, maturity phase, and then the early design phase was really key on there. But otherwise, nice little question. Another 2 in the bank. So we're starting to look onto question 13 now, so stay with me. We're nearly finished on section A. And what we're asked for here is what is the throughput accounting ratio? Okay, so in other words, if you know what the throughput accounting ratio is and linking it to what we're given in the question here, which you can see on here, we've got machines, so it's going to be relating to machines on here. Actually getting down and applying the figures, what it's actually relating to. So let me just walk you through the actual question again. So the company manufactures a product which requires 4 hours per unit of machine time. Machine time is a bottleneck, okay, so it's a finite resource on there. And as you said, the resource, as there is only 10 machines which are available for 12 hours per day, 5 days per week, okay? So that's all we've got for machine time. The product has a selling price of $130 per unit. Okay, so we're getting into the costing element now, which is more than likely going to fit into our ratio. The direct material cost of $50 per unit, labour cost of $40 per unit, and factory overheads of $20 per unit. These costs are based on weekly production and sales units of 150 units. Okay, so as ever, pause the video, have a little attempt yourself, and then we'll run through the actual key throughput accounting ratio. Okay, so it's all going to be, let's pull it back onto the actual question now. It's all going to be about the actual output of these machine hours, simply divided by the actual costing relating to it. And a little tell within this question was, how do we split the costing out? Well, the labour cost on here, before we go on to the answer, the way I try and interpret it is that we've got $40 here and 20. They actually relate to the actual factory itself where it's being produced for the output wise. And then the costing, we've got, well, the selling price less the direct cost to actually make it. And obviously we've got the 150 units. So let's have a look on the actual explaining of the answer on here now. So let's just break it down. And as you can see on here, all we're taking is the return per factory hour, okay, and then dividing it by the factory cost per hour. So the $130 minus the 50, notice how they actually laid it out in the question for you to try and keep it separate. So it's all about the return on the factory from a selling price and direct cost perspective. Divide that by 4 hours as a result on here, and that gave us $20 per hour, okay? Then we've got the actual factory costs of the 40 plus, okay, the 20 on here. So there's the 40, as you can see, and there's the 20 on here. And then we simply took to get the throughput accounting ratio of 20 divided by 15, and that gave us the 1.33 as a result. But it's just picking up on there for you just to say, well, okay, well, how can we actually work this through as well and actually go to yourself, oh, it's actually not too bad on there. Just a little thing as to, well, how do we actually lay this out, calculate it through, and just splitting out the actual expenses as a result on here. Okay, so that's nice and easy for number 13 on here. Let's have a go on to next on here for the next one. So what have we got? We've got the actual Oxco has 2 divisions, A and B. And again, oh, hang on, we've got the actual pull down. Important stuff. So it's actually saying, if Division B accepts Colco's offer, what will be the impact on profits per year for the group as a whole? Okay, so we've got an increase, we've got a decrease, we've got a decrease, and an increase on there. Okay, so we've been given some figures. Impact on the profits In other words, are we going to be in a better or worse situation? So as ever, let's just work it through on here. So we've got to have a look through on Oxco has two divisions, A and B. Division A makes a component for air conditioning units, which it can only sell to Division B. Okay, so let's just clarify that. Division A makes a component for air conditioning, which it can only sell to Division B. It has no other outlets for sale. So that is it. All they do is sell to Division B. And the actual cost per unit to do that is $100. The actual transfer price of the component, if it went externally, would be $165. And then we've got the total production sales of the component each year of 2,200 units. So total production 2,200. Specific fixed cost of Division A per year is $10,000. So if we actually closed it down and we didn't go through it, then they'd be reduced. And then Coldco's offered to sell the component to Division B. So this is where Coldco comes into it. So Coldco, think of it as an external party to this as an alternative measure. So should they accept the alternative measure or not? Coldco's offered to sell the component to Division B. So scrap Division A, we're going to go with Coldco on this for $140 per unit. If Division B accepts this offer, Division A will be closed. So that's where the 10,000 comes into it. So if Division B accepts Coldco's offer, what will be the impact on the profits per year for the whole group, for the group as a whole? Well, straight away, you've got to be thinking there, well, $140 minus the 100, oh, hang on, pause the video if you want to have a go at it yourself. Got carried away there, enjoying it as we're going through. And then we'll explain the answer. So give it a go. I've already given you a little hint anyway. Right, let's explain the answer. Now, as you can see on here, first of all, we had the actual increase in variable costs. So we've actually got the marginal cost to produce one more unit if we are Division A is 100 versus if we bought it in, it will be 140. So that is an increase of $40. Then if we're going to have the same amount of units that we require, the 2,200 units, we've got to multiply it by that increase. So that's, in other words, the cost going up as a result. And then say to yourself, well, okay, well, if we actually went through this external party, we would then shut down Division A, which has fixed costs of 10,000, which would not be incurred. Hence, the 88,000 minus the 10 shows us that the costs are going to go up by 78,000, and hence that is going to give us a decrease in the profit of 78,000 as a result on there. So decrease of 78,000 is the required answer. Now we have to ignore the transfer price because then that would actually be a result if we transferred that actual component external to the business if we were Division A. So that's why it is ignored on here. So decrease of 78,000, lovely stuff on there. So onwards to the last one on here. Stay with me all the way to the end on this. And finally on here we've got to, again, we've just got to select one or the other on here. So identify by clicking the relevant box in the table below whether each of the statements regarding Fitzgerald and Moon's building blocks model is true or false. And automatically you're saying to me, James, I can't remember Fitzgerald's Moon and building blocks model. Well, just think of it, it's split up into 3 different areas, but before I walk and talk you through, again, pause the video, you want to have a go, read them through as well, and then we'll go through and actually analyse this. So, the 3 blocks you need to be aware of are the dimensions, the standards, and rewards. If you haven't had a look at this, go have a look. There's an article on ACCA's website, and it will be in your actual performance management textbooks on there. Also, we've just got to go through it because it's actually just separating out what goes into those 3 little blocks on there. So the determinants of performance are quality, innovation, resource utilisation, and competitiveness. Is that true or false? Well, if you go through it, it'll actually tell you on there that potentially one of those, or are they all right, or is one missing, or have they changed the word on it, should we say. Standards are targets for performance and should be fair, achievable, and controllable. Okay. Rewards encourage staff to work towards the standards and should be clear, motivating, and controllable. And then finally, it is a performance measurement framework suitable for service organisations. So let's start to have a look on this as we go through. And I'll pop it over to the side here so we can just, oh, there we go, they'll nicely align on here. So the determinants of performance are quality, innovation, resource utilization, and this is where they nicely change one of them, and flexibility. Competitiveness is a result of the actual detriments on there as a result. So on there we have competitiveness, whereas here we have flexibility, which is the correct answer on there. So that is false on there. The standards are targets for performance and should be fair, achievable and controllable. So standards should be fair, achievable, and staff should have ownership of them. Controllability is a feature of the rewards block. Okay, so if you haven't got it jotted down as well, rewards block is one of the key ones on there, along with the dimensions and standards block as a result. Then we've got to say rewards should be clear, motivating and controllable. Clear, motivating and controllable. Lovely, nice and easy and true, but why is it going red? Should be green. And then it is framework designed to attempt to overcome problems associated with performance management in service companies. So performance management framework suitable for service organisations. Lovely, nice and true on there, but it was one of those where if you knew the model, you knew the 3 blocks, and you knew the sort of characteristics in the 3 blocks. If you didn't know it for this question, just have a look at it to actually review it going away from today. And it's just going to be trial and error, should I say, and practice going through. But that takes us through number 15 on there, and we all know what that means. That takes us to the end of section A, the end of this video, but let's head back to the main screen for a few final points. 3, 2, 1. Now then, Shruti, what did you think about that? That, in my eyes, is how you should be going through and analysing a section A of the performance management exam, top to bottom. I've also got to give a lovely shout out to JP. He got in touch with me on Instagram as well, so I really hope that video helps you out to pass your upcoming examination. If you found today's video helpful, as I said, make sure you give it a massive thumbs up below so more ACCA students can see my videos. And let me know in the comments if you want any other videos doing, because as you saw at the back end of that video, there was also section B, which I will be doing a video on my channel. So make sure you head over to that after this and go and check it out. Finally as well, make sure you subscribe so you get all of my other updates. I do videos on all of the modules for ACCA, along with a variety of other videos that are going to help you out in your ACCA journey. Well, the final thing I can say is, best of luck with your upcoming examination. Let me know how you get on. What I've done for you as well is I've left some other videos at the end here. Make sure you click one of them because they're definitely going to help as well. But as always on that bombshell, I'll see you next time. Cheers!